Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at EON resources.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis.
Okay, we are jumping right in with EON resources because their third quarter for 2025, it presents this fundamental contradiction.
It really does. On the surface, the headlines looked fantastic. They posted a record net income of, what, $5.6 million?
A record. And that's the headline everyone focused on, which makes sense. It's a massive reversal from the first half of the year.
Massive, yeah. Remember, they were just bleeding cash. A $1.57 million loss in Q1, and then another $1.3 million loss in Q2.
So seeing a $5.6 million profit, that's got to be an inflection point.
It looks like one. But here's the critical thing you have to focus on as an investor. That net income, it doesn't represent operational success. It's what you might call a paper turnaround.
A paper turnaround, so not real.
Well, the money's real, but the source is the key. If you look at their revenue, their trailing 12 months revenue is $18.19 million.
And that's actually down from 2024.
Exactly. It's lower than the $20.27 million they did in 2024. So if revenue isn't surging, where did that profit come from?
Right.
It came from a non-recurring event, a big one, a $13.4 million gain specifically from asset sales.
Ah, so they sold something off. They sold a piece of the company to fund this big financial restructuring.
Precisely. It was a strategic move, not a sign that the wells suddenly started, gushing cash. They used that gain to tackle the major structural problems they had.
Which really gets us to the most important story here, the balance sheet overhaul.
Yes. Let's unpack that because it's all about getting rid of these structural liabilities. In September of 2025, they closed this huge $45.5 million funding package.
And that was a mix of things, right? Volumetric funding and a farm out agreement.
A very smart combination. And what's fascinating is what they did with that money. They didn't just rush out to drill more wells.
No, they spent it cleaning up the books.
They did. $37 million went to retiring existing debt, but, and this is crucial, $27 million was used to redeem preferred shares.
So for our listeners, can you explain why getting rid of preferred shares is such a big deal for a company in this position?
Of course. Preferred stock. It's not like normal stock. It often carries these mandatory high dividend payments that act just like debt.
They're obligations.
They're structural obligations that just eat into your cash flow month after month. So by retiring $27 million of that, they plugged a huge, predictable leak in the boat.
That's some serious leverage control.
Yeah.
And you can see the result immediately. Shareholder equity jumped by, what, $22.7 million in Q3 alone?
And if you connect this to the bigger picture, the balance sheet is just fundamentally healthier now. Zero preferred stock. A much lower leverage ratio.
That gives them flexibility.
So much flexibility. In the energy sector, that lets them move faster than peers who are still drowning in debt. They've cleared the runway.
And they're ready for takeoff.
Yeah.
I mean, the operational implication here is huge. That new structure, the liquidity, it paves the way for drilling up to 90 horizontal wells.
Yes, over a multi-year program. But here's the absolute best part for EON.
Go on.
The total cost for that 90-well program is expected to be over $300 million.
Oh.
And that money is being funded by partners.
Partner-funded CapEx. That's the dream scenario, isn't it? It minimizes their risk.
It does, but there's always a trade-off. If partners are putting up $300 million, you have to ask what EON is giving up.
The upside, I imagine.
A piece of it, yes. That's where the farm-out agreement with a company called Virtus comes in. EON essentially trades a share of the production in exchange for the capital and the technical know-how to get it done.
So they get to develop their resources way faster than they could on their own.
Immensely faster, and that's key because their real strength is that resource base. We're talking about 14 million barrels of oil and 2.8 billion cubic feet of natural gas improved reserves.
And those were independently verified. So this isn't just their own estimate.
Correct. The Virtus partnership is the catalyst that makes those reserves actionable right now.
So we have this very positive picture then. Debt is gone, liabilities are cleared, funding is secured, and there's a huge partner-funded drilling program lined up.
That sounds great.
But There's always a but, isn't there? We have to talk about the anchor dragging on all of this.
The going concern warning.
Exactly. The company itself disclosed that there's substantial doubt about its ability to continue as a going concern.
And that's the major caution flag. How can a company that just fixed its balance sheet and got $45 million in funding still be worried it might not survive?
It seems like a total contradiction.
The answer is in the difference between net income and operating cash flow.
Right. The Q3 net income was positive, but that was from the asset sale and investing activity.
Exactly. When you look at the core business operations, the picture gets a lot darker. As of September 2025, they had a negative operating cash flow, a loss of $9.52 million.
And that cash drain creates the real problem.
It leads directly to the core liquidity issue. They ended the quarter with a working capital deficit of almost $10 million, $9.94 million to be exact.
And their cash on hand?
Frighteningly thin, just $875,000.
Wait a minute. That's incredibly thin ice. It completely explains the going concern warning. They solved their long-term debt, but not their day-to-day cash crunch.
That's it in a nutshell.
So hold on. They just raised $45.5 million, but still bled $9.5 from operations. Where did all that cash go if the partners are paying for the drilling?
Well, a huge chunk of that $45 million immediately went out the door to retire the debt and the preferred shares. That was a brilliant strategic move, but that cash never hit the operating bank account.
So their day-to-day operations are still not generating enough cash to cover costs.
Not yet. Not before the new wells come online. They bought themselves breathing room on the debt, but they are absolutely racing the clock on the operating side.
What's management's plan then? How do they survive this?
It's a three-pronged plan. 1, aggressive cost controls. 2, hedging their production. And 3, this is the big one, relying on up to $150 million of conditional equity funding.
Conditional. That word is doing a lot of work there.
It is. That funding is their lifeline. If they can't access it or if the cost controls don't work fast enough, the whole risk profile changes overnight.
So if that funding falls through, how long do they have?
Given the deficit and the burn rate, you're probably looking at a runway of maybe 3 to 6 months, max, before they'd have to sell more assets just to make payroll.
Which brings us to management's behavior.
Yeah.
We have to look at insider activity, especially in a situation this tense.
Yes, and we saw some notable sales in September. A director, Joseph Salvucci Jr., sold 156,000 shares.
And the CEO sold some as well.
He did, disposed of 10,000 shares. And look, insider sales are always tough to read. It could be for personal reasons.
But the timing is terrible.
The optics are not great. When a company is warning about its own survival and executives are selling, you have to question how much they believe in their own turnaround plan. It just adds a layer of scrutiny.
Okay, let's pivot for a second. Despite all this risk, the market seems to be pretty optimistic. The stock has been acting very strong.
Extremely strong. It's rebounded dramatically from its low this year of around 26 cents to recent levels near 53 cents.
So it's basically doubled.
It has. The technical chart confirms that the market is weighing the long-term potential, the debt fix, the drilling program, more heavily than the short-term cash risk for now.
What are the signals?
The stock has crossed above its 5-day, 60-day, and 200-day moving averages. That's a very strong confirmation of a bullish shift in the trend.
And momentum isn't flashing any warning signs.
Not yet. The indicators are neutral to slightly bullish. It suggests there's still room to run, that the stock isn't overbought just yet.
But that continued momentum has to depend on good news.
Absolutely. Unfortunately, we have a few very specific near-term catalysts coming up in the next, say, 0 to 3 months.
Okay, what are they?
First is the Q4 2025 earnings report, which we should see in February 2026. The market will be laser-focused on that negative operating cash flow number. It needs to shrink a lot.
Makes sense. What's next?
The second catalyst is maybe even more important. It's the launch of the Virtus farm-out drilling program. Seeing them actually start drilling those wells will validate the whole story. It's proof they can execute.
Turning the deal into steel in the ground.
That's it. And finally, management has signaled they're looking for more deals. We could see new M&A or other partnerships which would add momentum and potentially ease that reliance on the conditional funding.
So the long-term view seems pretty clear. This 90-well program, in a good environment for energy, sets up a compelling reward scenario if they can survive.
That's the whole story. High risk, high reward. On one side, you have this incredible structural turnaround. Clean balance sheet, Debt gone, growth is funded.
But on the other, you have this immediate, really severe liquidity crunch, negative cash flow, and their survival hangs on getting that conditional funding.
It really is a story in two parts. A structural turnaround that's already happened and an operational one that's just beginning.
A financial turnaround versus an operational one.
Exactly. The Q3 net income shows the financial turnaround is done, but it was done through an asset sale. The critical question now for you, the investor, is can they translate that partner-funded operational growth, that massive drilling program, into sustained positive operating cash flow in 2026? If they do that, the going concern risk evaporates and the thesis works. If they can't, the whole thing could still crumble. That operational pivot is everything right now.